Hello traders, you're welcome to this video and you're welcome back to the Forex Geek channel. Now in this video we are going to be looking at one of the most critical parts of Forex trading, and that is volatility. Okay, so in this video we are specifically going to be looking at some of the best volatility indicators. Okay, if you are looking to sharpen your trading strategy, understanding volatility indicators can really make a difference. All right, so we're just going to be breaking down some of the best indicators to help you read the market's movement and adapt your approach. So let's get into it. First up, let's talk about the average true range, okay, or the ATR. Right, let us talk about the average true range indicator. All right, now this indicator is essential for measuring market volatility over a specific period. Okay, as you can see, you have to select the period. This is 14 period. The default settings is the 14 period. All right, so if you are on the daily time frame, then it means it's the volatility measurement over 14 days, right? So simply put, it shows us how much an asset moves on average, giving you a great sense of price stability. Now, if the ATR is high, that typically means there's increased volatility. If it's low, the market is calmer. Using ATR can help you set stop loss levels and plan your trades with more accuracy. All right, so basically, you want to be looking out for how high this ATR indicator goes. Okay, you want to be looking out for how high it goes, to indicate the level of volatility. All right, so you can see how the ATR, you see, during this period of it just moving sideways, you can see how we had low volatility around this point, right? You can see the low volatility we had around this point, but coming towards something like this, can you see what happened here? You can see how the ATR also rose in value, right? You can see how it had a sharp move, okay? And you can see something like how there was high volatility here. You can see how the ATR also responded accordingly, right? So secondly, the next indicator we are going to be looking at is the Bollinger Bands. The Bollinger Bands can also help in terms of volatility, right? They are popular because they are simple yet powerful. Bollinger Bands create a range around the price that expands and contracts based on volatility. Now, when the price moves outside the bands, it often signals that the market may be overbought or oversold, right? So if you see price touching or moving beyond the upper or lower band, it's a sign that a price reversal might be around the corner, okay? So for example, when you notice the bars, the Bollinger Bands widening, it shows increased volatility. For example, around here, you can see how the Bollinger Bands were widening apart. It shows that there is increase in volatility, all right? But when you notice that the Bollinger Bands are somehow shrinking or somewhat coming together, it shows that there is decreasing volatility. All right, so basically that is how it works. The Bollinger Band reveals the level of market volatility by either widening apart or contracting. Okay, when it widens apart, it shows increased volatility. When it contracts, it shows a decrease in volatility. All right, now let's talk about another indicator, another favorite. That is the Keltner Channels. Okay, so I'm just going to be adding the Keltner Channels to the chart. All right, the Keltner channel, we're going to be adding it to the chart, and here we go. Okay, so I'm just going to remove the Bollinger Band so we can see the Keltner channel properly. Okay, all right, now this works, the Keltner channel works similarly to Bollinger Bands. Okay, it works similarly to Bollinger Bands, but use the average true range to adjust the channels. Okay, use the average true range to adjust the channels. Now with Keltner channels, you are looking at the relationship between the price and the channel boundaries. All right, when the price breaks out of the upper or lower channel, it can indicate the start of a trend. For example, we can see how when price broke above here, we can see that it indicated an increased volatility. So unlike Bollinger Bands that widens when we have increased volatility, as for the Keltner channel, you tend to see price breaking out of it and perhaps moving above it for a bullish volatility or a bullish move. Then in the case of a bearish move, you will likely see price breaking below the lower channel and beginning to move somewhat below it. All right. Then in the case of lower volatility, you might just see price consolidating within, but when you have a higher volatility, you can see how price pops up above the upper line or pops below the lower line when it's bearish. Okay, so volatility indicators like these are invaluable because they help us understand how active the market is and where it might be heading. Now, they are especially useful for identifying potential reversals or the start of new trends, which can help you time your entries and exits more effectively. But remember, no single indicator should be used alone. Combining them can give you a much clearer picture of market conditions. Now, if you're finding this information helpful, make sure to hit that like button and subscribe for more content just like this. It really supports the channel and helps us bring you more tips on becoming a better trader. So to recap, we've covered the average true range, Bollinger Bands, and Keltner channels, each one offering a unique way to measure volatility. Experiment with these indicators and see which combination works best with your trading style. That's the key to making the most out of them. Thanks for watching, everyone. Leave a comment below if you have any questions, and don't forget to subscribe for more trading insights. See you in the next video.